All right, wait. Let me start off. Or you do an
You
intro
can
because
start.
I want
Yeah,
to
let's
make I
start.
want to do my medicine.
Do,
Yeah.
do your
Can
medicine
you read that?
cocktail.
We got tariffs. Okay.
What are you doing?
Yeah, this one.
Shots. It's 8 in the morning.
Doing shots. 8 in the morning.
All right. What is this? Reduced government spending. Like a ton of reduced spending. A lot of giant contracts being terminated or reduced. Jobs lost. Oh, let's add inflation. Debate. There's debate amongst us whether or not inflation will remain sticky. All right. And then what do we got here? What's the last one? Oh yeah, declining sentiment. So like maybe things haven't gotten bad yet, but just the perception that it is causing issues. Like I had a client literally yesterday potentially going to buy a new house. Now they're backing out because they're worried about the market. So it's like sentiment, that's important. All right, let's mix it up. All right, what does this make? Let's see.
That was a weak mix, by the way. I don't think you'll ever.
Dude, can we shake a little harder?
All right,
You
stop.
know, at the bar, like they always do it obnoxiously long. You know what I
Oh.
mean? And you're just like, can you just shake it like twice and just give me the drink? You know what I mean?
That's why you're paying them so much.
Yeah.
Oh, that's bitter, dude. Recession, bro. Yeah, which, dude, I swear, sometimes I think like being a stock analyst must be like the easiest job in the world because the market's already priced in a potential recession based on all those things. Now all these companies, JP Morgan, Morgan Stanley, Citi, now they're like, "Oh, we think there's a possibility of recession." They're basically just taking what's already happened. Like none of them are actually predicting anything. But anyways, so
Yeah,
all those
they just
things
came
mixed
out and
together.
Likely.
Yeah.
Recession is likely.
A little too hot of a take right there, but that's all right.
Yeah, we'll see. I don't know about that. We'll see.
They're like, "Oh, we're adjusting our price targets now for Apple." Like the market's already brought the stock down so much. Now you're coming in after the fact. Like, but
Yeah, but I mean, yeah, I know what you mean. It would be nice if they were a little, you know what I mean, a little more ahead of the curve. But that's part of their job is reacting to what the current, you know what I mean, prices and things like that have done. So
Yeah.
I think that's a little harsh, Eric. A little harsh.
I think Apple's a great deal right now. It's down
it's pretty
26% from its high. That's a bargain.
It's a bargain at its current price, but
what? Yeah, what's its PE right now?
it's still around probably 30. You know what I mean? Something like
I'm
that.
just trying to be my reaction, like my.
What's crazy is for years it was trading around like 12 times earnings for years and years and years, and yeah, could have just been loading out that entire time.
But Bill, that's part of the argument some people make is that some of this pullback isn't 100% tariff news cause. A lot of it was a lot of these momentum trades were just too hot. Like Apple was at like a 38 PE for
Yeah.
for a company whose revenue was only going at single digit percentage. You know what I mean? It was going up at single digit percentage. Their margins were doing better because a lot of they were getting a lot more service. That part of their company was going up a lot, so their margins were improving, but their revenue was not going up. It's not like they were seeing 15-20% growth, and you know what I mean, in revenue. It was single digits and at getting it at a 38 price to earnings. That's pretty expensive depending on how you look at it. Someone showed me something else on why that could be justified. Maybe I would understand it, but at first glance that looks a little rich.
Welcome everybody to another week of Wealth Wisdom, where we're helping you build wealth and legacy.
Companies are like an organism trying to survive.
it's always a risk when you're investing in a company that's purely tied to someone's brand.
45% of Americans have gone into debt for a Disney trip. Yeah. All right. Well, let's get into the show. Welcome back to another episode of Wealth Wisdom, brought to you by Fox Hill Wealth Management, your trusted source of financial planning and wealth management for young professionals and retirees and everybody who needs help. I'm Justin Obi, your host, and today we have cocktail enthusiast Eric Benz with us and tax aficionado Bill Ryan coming to us live from Fox Hill headquarters there, just in Boston, Massachusetts. Today we're kicking off things with a brief look at some of the top stories shaping today's markets, including the latest development with tariffs, interest rates, current market volatility. There's a lot of it going on. We're going to share our insights into what all this means for you, investors, and why staying calm throughout uncertainty is critical for your long-term success. Then we're diving into the main topic, how young professionals, especially those at fast-growing, high-flying companies, can effectively build, manage, and diversify their wealth. Let's get into it, boys. Let's get started. What's going on with the markets
I
this
feel
week?
like you could tell that I don't drink by my whole setup
I was
there.
going to say that's a fraudulent statement about Eric Benz being
A cocktail aficionado?
yeah, who once said either in an email or in a Teams chat, he was talking about how a particular restaurant had the best mocktails in the city, and I was like, how on earth would you know that? Yeah.
Well, I had a different title for you, but with that introduction this morning, I had to switch it up on the fly. It's great. Crazy roller coaster of a week this week in the markets. I mean, talk about whipsaw.
Oh yeah, I mean, when I was first watching it on Wednesday, I was like, geez, I can't even remember. You know what I mean? It ever shooting up like that. Ever, you know what I mean? And I was thinking, I was like, in my career, have I seen that? And I guess there has been a few times that it's come close and stuff like that. But yeah, it was, and the way it happened too, right, over the course of 20 minutes, 30 minutes, So.
It was crazy. I mean, it was a 10% swing as soon as they announced the pause in tariffs. It was just, and I think right before that, Trump tweeted out, "It's a great time to buy." Which
Dude,
has people talking.
I don't know, Justin. We were in a meeting.
yeah, is he allowed to do that?
I know.
I said
remember
that.
Justin. You said that. You came out with that tweet. I literally then
Yeah.
had to do more work, and then I opened up. You know what I mean? Schwab, and I was like, "Whoa, what is going on right now?" You know what I mean? Right now, because I missed basically the 20 minutes. You know what I mean? Where this all happened, and
Oh, it's crazy.
Yo,
Yeah.
wait, Justin, do you know like what's going on with tariffs right now? Because I feel like I read a different article all the time. I have no idea what's in place, what's been paused, like what is going on.
So the latest I've read, and this was as of last night, there's probably something going to happen this. But right now at 8:22 in the morning, recording this on Friday, April 11th. Here we've got yesterday they paused tariffs on Wednesday. They announced it, but there's still like a 10% tariff in place. So they paused reciprocal tariffs for majority of the countries who were not retaliating. So they're trying to reward the countries not retaliating. China has retaliated, and now I think we're up to like 145% on them.
we're now both tariffing each other 500%.
I think, Kevin O'Leary came out and said China should be 400% tariffs. He finds it extremely hard to work with their country.
He's really leaned in. Yeah.
Yeah, he's in all the headlines. Great job. So I think that's where it is. 145% tariffs from China. I think, although I also read a headline, an article the other day, China's reaching out to the other countries, trying to create a unified front against the U.S. So, the saga continues.
Well, yeah.
I would do the same thing if I'm China. It's an obvious move. I mean, it's a game theory, but so that's where we are. And markets reacted positively when Trump came out and paused. That I think that accounted for the biggest swing right there. That was the 10% swing on Wednesday.
Yeah, which I think was good just to breathe a little air too, like just overall, because having that upon announcement of the tariffs and seeing that drawdown happen as violently and as quick as it happened, and with a lot more blood, you know what I mean, on the horizon, that was, I think, a necessary move to do. Again, especially with something that can be so disruptive in the short term, just to give companies the ability to plan, think about what's going on, strategize. I mean, there was no time, right, to do all these things, and all the that would be really tough. If you're a CEO of a company trying to
Oh, sure, navigate all of it. It's really hard. And I think that's been the biggest problem with a lot, what I've heard is companies just have no idea what to do, right? It's been on, it's off. Apple just I believe they basically shipped overnight like tons of product out of China just to
I saw that article.
deal with the uncertainty, and they moved
Yeah.
it to India real quick to react. I mean, they have to do something. You have to make a decision as a leader in in a company today. So it's like, what do you do? I think they made a good move, but it's hard. It's very hard, and it's affecting all sizes. Even neighbors of mine are like, I gotta buy the stuff from Amazon now, right? Like that was like a month ago. Tariffs are coming. It's affecting everyone's mind space. So, CPI came in as well yesterday. So, that was an interesting 2.8% in February, and now it's down to 2.4% in March. Good news. I think that's welcomed for all of us Americans here. Trueflation.com is actually reporting at 1.34%. So one of the lowest points of inflation we've seen in a while, which is fantastic when you think about what's happened in inflationary terms over the past 5 years. It's insane.
Yeah. Yeah. What was the height of inflation that right
Well,
after COVID,
reportedly,
COVID?
reportedly it was 11.6%. So 12% rounded up. But I mean, Eric, you know all the number. Do you have those numbers in front of you for the past 5 years? All these items. I mean, eggs up 308%.
Yeah. Crazy.
Yeah, but
wait.
those have come down now.
They have. No, they
Yeah.
have.
Going to the-
It's just the last 5 years. Yeah.
This is me going to the grocery store and seeing that it's I mean, they're up that much in the past. They're up 308%. I feel like
I think I think that was the height. They have now come down.
Yeah.
They have come back
I
down.
think that number might be a little
They're zonky.
skewed, but
But home prices.
Yeah, that is amazing. Electricity 34, gasoline 35%, used cars 34. That's
and that's across the
Consumers
country.
bearing a lot of
Here in
that cost.
Massachusetts. I mean, we had a 60-something% like rate increase.
on electricity.
Yeah, so I mean, I don't even. Granted, this is over 5 years, right? So
No, but I looked at my bill recently. I was like, wow, this can't be right.
you're like, man, I really have been cranking the heat this year.
And that's the thing. I'm like the light guy. I turn them all off
Yeah.
constantly.
You're like, did you,
Probably doesn't even matter anymore because they're all LEDs. I don't know how we're spending more than our parents in electricity with all these LEDs.
inflation, bro. So okay, but going back to this, yeah, positive numbers.
Yeah.
That report came out yesterday, right? Market
Yes.
still went down like 4%.
Yeah.
My question to Bill, maybe like you have a thought on it, is like, are people don't really care about that number? They're more concerned about the inflation going forward, and they don't think that this has an effect on that. Like, why was the market down 4%? That's the question.
yeah, I mean, well, one part, right? We just came off a record day, so how
Well,
often,
too, yeah.
I mean, you have a record day, you usually have like a pullback. They're like, well, people are still thinking, these tariffs are still in place. Let's not get ahead of ourselves. You know what I mean? This is we're not out of the woods yet. So I think that played a role in it. And I also just think that inflation, it's now that's on the back of people's minds. We're thinking about this future inflation that could, because if you listen to on the news and you know what I mean, everything like that, or reading, all you're going to hear about is the inflation that takes place when tariffs get put into place, right? So,
I mean, tariffs have been in place already, like technically, right? Like this is just the liberation day.
yeah, they've just added
Yeah.
significantly to those
Right.
tariffs. I mean, every country in the world has them. Even little penguins have them. You know what I mean? So, but no, this is now. It's just that they're adding to them, right? They're making them. They're larger tariffs. So, what that disruption does to the markets, to the consumer.
So we were debating this early before we pressed record. Tariffs, inflationary or deflationary, and traditionally, you guys, it's always inflationary. However,
Yeah, I mean, I think for the U.S. consumer, they're going to be inflationary.
Yeah.
Right. Whether you argue it, is it going to be temporary? You know what I mean, in nature, or is it kind of just going on forever? Now all these goods are just going to cost more. If you're producing a good in another country and you're bringing it into the U.S. and now they can't afford it due to the current tariffs, are you going to be forced to now lower your prices so that with it, somewhere we can have some type of break even on both parts, the seller and then the receiver of the goods? That would be a deflationary event. So perhaps it, you know what I mean? It might be in some sense, and then at that point, can we release the tariffs, right? Once prices have come down enough, which then would be another win for consumers if that were to play out that way.
yeah, I mean, it would be interesting to see how it affects inflation, because I mean, there's so many pieces that go into the CPI number, right? That bucket of data, like hotel prices, airfare, those prices have come down recently, which is one of the large reasons why inflation just came down, by 0.4%. So consumer spending is down overall. Like sentiment, I think you just put that in the bitter cocktail, Eric.
Yeah.
It's not good. People aren't happy, so people are spending less money. So that'll be interesting to see how it plays out. I want to hear from our viewers. What do you guys think? Put it in the comments below. But yeah.
Yeah, I mean that is a interesting point, but trade war with China, where we're getting everything from. That's
Well, the other thing is all of this is moving so quickly. All this is moving so quickly.
Yeah.
Who knows what happens, right? Like the tariffs were on one day, now they're off. I mean,
yeah.
this
Well,
is
I
April
think that's
11th.
why
Crazy.
that's why the market was so positive post-election. I think people thought the tariffs were mostly just bravado, right? It wasn't real, and then it became real.
True.
And then the Nasdaq was down 25% from its top. We had that quick rally, but there's still a big fight with China.
You talk to a lot of people, and they say like Trump always does what he says, and he's been talking about tariffs for 40 years, right? So now he really, you know what I mean? So people were like, I don't know why you're surprised, or if people are surprised, right?
I mean, he ran on it.
Surprised, he's been talking about it constantly. His favorite little word, right, is tariffs, right? So, so people are saying, hey, you shouldn't be surprised. I think the market had priced some of that in. Again, they just didn't realize the extent. And once the extent came in at much higher than where everyone even anticipated, just, you know what I mean? That's that negative news, and now, how that ripples through the economy because, like you said, consumer sentiment, now people, maybe do spending some stuff now because they say, hey, I want to buy some things that I had been kind of on the fence about, and I want to buy them now before they go up. But then other people are thinking, my costs are going to be going up over the next year, 2 years, and I got to buckle up, so I'm not going to be spending, right? And that might be more of the majority, right? At least right now, or at least that's at least how the market reacted. The market reacted thinking that was going to happen. So as it went down,
Is the market assuming that the 90-day, what's the 90-day pause for again? Is the market assuming that means they think deal making is going to happen and those tariffs will be significantly less? Like what are we assuming?
Yeah, I think so.
Yeah.
I mean, Europe is already coming to the table saying, hey, we'll negotiate.
Yeah.
And I think if Europe comes to the table, a lot of these other countries are going to do the same.
Yeah.
And that's probably why China's trying to say, hey, wait, hold on, stop.
But I mean, if everyone makes deals with the U.S. and China's last, they're not negotiating from a position of power anymore.
And I don't think China has much. Their economy's pretty weakened. It had a really bad real estate plummet They've been artificially keeping up their economy for a while. So I mean, the tariffs are going to
Yeah,
hurt
well-
them more than it hurt us as a net exporter, right? So they're exporting more goods to the U.S. than we are exporting to them. So
a ton more. Yeah.
right, so the tariffs actually hurt them more.
6-1 or something like that. You know.
Yeah. But you have an interesting story with treasuries as well. So that's all. This has been one of the biggest downturns in the 21st century, according to Statista.com.
How fast and how quickly it went down?
Yeah, I mean, we're in correction territory, 10% for the year, right? So S&P is down 10% for the year. In the dot-com bubble was 49%. I mean, it just makes it, down 19%. I was, my bad. Down 19%. But inflation crisis 2 years ago was down 25%. COVID was 30%.
COVID was quick.
Yeah, but that was
was
like,
quick,
yeah,
so.
it was like,
Yeah.
drop.
Which you could argue this. I have a theory that this whole thing could follow COVID if deal making does happen quickly.
Yeah.
Because it's a similar scenario, right? COVID was like a big supply chain shutdown, which led to inflation. Tariffs are going to slow down the supply chain, which leads to inflation. If we do some deal making, get that stuff out of the way, we should see the market rally quickly. But it's all dependent on the whims of our fearless leader. So could follow that scenario though.
Yeah, in COVID, right? It was the fear of the unknown. We didn't know what was going to happen,
Yeah.
how it was going to spread. If you know what I mean? If people could even go outside, quote unquote. Did you have to wash down your packages?
vegetables.
Dude, I was wiping down groceries. I was thinking about
I was cleaning that. I was cleaning groceries. It's absurd.
But leaving packages right in the front hallway. Don't touch them.
Right.
Don't touch them. You know what I mean? For
Right.
2 days.
Right.
Whereas this is, can go on a whim, right? You know what I mean? So these tariffs could just as easily go away tomorrow as they were put in today.
But do you guys have clients panicking? Are they calling you saying, "Hey, what should we do here?" Because I think there's a lot of that seemingly like panic. The headlines will make you feel like you have to panic right now.
We've had a few, not too many. Like I do feel like if you're doing a good job as an advisor, right? You're the one reaching out to them actually and checking in. But also younger clients tend to know, hey, if it's a retirement account, I'm actually not touching this. I'm comfortable with the ups and downs of the markets. I know I need to be in it for the long term to make more money, right? They usually tend to get that. It's the older clients nearing retirement. Maybe they aren't used to not having income coming in the door, and all of a sudden they see their net worth cut by 20%. That's when they start to panic. But if you've worked with them, gotten them comfortable with the market, or maybe took some risk off the table beforehand, you've done a good job and they don't have to worry. But yeah, we've seen more clients call in for sure to check in and see what's going on.
Yeah, I mean, anytime there's a drawdown, especially something that quick, it's going to cause, you know what I mean, some people panic. I mean, it's perfectly natural. I mean, you know what I mean? I get up, but you know what I mean? I get a little not jostled, but it's okay, all right, we're in for one here. Let's, excuse me, let's, you know what I mean?
But you don't lose money until you sell.
Like that. Yeah, totally.
I mean, if it's down, it's down. It's
But you don't because when you zoom out, the market's still up. 266% since January.
Right, but they don't see that.
Yeah.
Most people zoom out looking at, you know what I mean? They're not looking at how it's done over the last 2 years. What they're seeing is, okay, what was my account balance this month?
No, I get it. Yeah.
What was it 2 months ago? Okay. And I'm down 50, 100, 200, $300,000, you know what I mean? $400,000, depending, bigger accounts, even more, right? So, that's what they're concerned about,
Phil, what a lot of people do too is they think, oh, the market's up so much over the last 5 years, it can't possibly keep going up like that in the same manner, and then they panic.
Oh, for sure.
We had some clients try to do that in 2022, but started Ukraine-Russia war when the market went down. People were like, oh, it was so hot after COVID, no way it's going to continue up. Sure enough, it went back up So it's you don't want to do that.
Yeah, I just think that's our thesis, as a company. I mean, it's just like long-term bullish and just continue to go up. There's gonna be corrections all the time. It's just part of, like, it's not if but when.
Exactly. Yeah, it's just part of the economic cycle, right? There's going to be a lot of money thrown into a certain area that's going to push that. You know what I mean? Hopefully, then that investment in that area is going to push the earnings in those companies up. But there's always going to be overinvestment, and there's going to be some stuff that people try, and it's just not going to stick to the wall. It's going to lose money, and
Right.
that's going to cause some pullbacks. Once then we get more clarity in the situation, companies are going to react. They're then going to strategize and make plans to make money in that current situation. So, but yeah, it's not a linear line upwards. That's for sure.
Yeah.
So just moving to the next, I really wanted to talk directly to our younger audience today, specifically people who are probably working in corporate America, or maybe startup, well-funded startups, and they're flying through the roof. People who have gotten RSUs, ISOs, so like restricted stock units, and incentives, so like stock options. What do you guys tell those types of clients? Like, because I'm sure it's fantastic, to be all in on those companies, especially when you're tied to the companies with stock options that are going to vest over a certain period. But how do they diversify and build wealth over the long term? That's what I really want to dive into now that we're done with the market news.
Yeah, I mean, I'm a big believer. A lot of people build their wealth through like concentration, right? Through concentration in certain positions.
Yeah.
A lot of times in their companies, right, that they work for, they're getting these, like you said, these incentive stock options or these restricted stock units or options. And if that company does well, the stock does well, it's great, right? Because your pay goes up exponentially. However, you know what I mean? There is a time where you do need to think about, all right, let's take some of that concentration risk off the table, and let's diversify so that you could stay rich, right? You know what I mean?
Yeah.
So,
Yeah.
because you want concentration helps build, but then diversification helps keep you rich, right? So that's
I love that.
and it's
Yep.
trying to figure out which time is the right time to do that. I think a lot of times, a lot of clients, when they're working for a company, they're very emotionally involved, right? So they're looking, oh, things are going well at work, things are going, our stock price is going to continue to go up. I want to be here, right? This is where I want all my money, and it sounds great, but once it's had a pretty good run up, you probably, and even if you do, you still like the company, all right, that's fine, but take some of it off the table, right? So you take some of it off the table, and again, you're not changing up necessarily. You're still putting it in like-kind companies, right, that are also trying to grow. You know what I mean?
Yeah.
So it's not like you're taking your ability to grow your money away by selling some of that stock and putting it elsewhere. It's just that you're doing it in a safer manner.
Mm-hmm. For when it comes to stock options, Bill, what are the major? Because I've heard friends in passing, they're like, I just got screwed. I didn't understand the tax implications that came along with the RSUs or the incentive stock options.
Yeah.
What are the things?
RSUs are basically, so it'll give you shares,
Yeah.
right, on a grant date, and then once it vests, it becomes taxable income, right? So so you get 100 shares.
So I'm given 100 shares. They vest. I have to pay tax on that value.
Yeah, they're $10 a share, right, when you get them. So they say, hey, we're going to give you 100 shares, right? But now it's a year later, okay, and that's when it vests, right? So say you get, let's say 100% of them vest, and so $1,000 will then go into your W-2. You know what I mean? Or they'll sell off for taxes. So they might sell off 75 shares, right? Pay for the taxes.
Yeah.
tax withholding, and then you'll get 75 shares in which you then can hold, right? That starts your ownership cycle, right? Your ownership period, or you can sell it right then and and just take the cash.
So if I want to hold on to them, I still have to pay tax regardless.
Yeah, you have to pay tax at that point. So let's say you get 75 share, you know what I mean? You're so now you're at $750, right? That's what your basis is now going forward.
All right.
So let's say now it grows to 1,000, but it's within a year and you sell, you're going to have a short-term gain of $250 that you have to, you know what I mean, that you'll report. If you hold it for over a year, let's say it's a year and a day and it's growing back up to 1,000, you're going to have a long-term gain.
Yeah.
Of $250. So
what's the best strategy for folks who are in this position? Usually, like, how do you?
So, well, as the stuff is vested, they want to have a kind of like a decoupling event, right? You know what I mean? Where they start moving away some of those shares and then diversifying out maybe to, 10 to 25 different companies, right? Different sectors, different, you know what I mean? Things along those lines.
Yeah.
And it maybe it's something where they've kept a lot of the shares over the years. All right, let's start selling off, some of those long-term positions, right? Because you get preferred tax treatment, and let maybe some of your short-term positions continue to grow, right? And then that way we can kind of push the tax stuff down, you know what I mean, down the line a little bit. But again, you're taking a little risk off the table. Mm-hmm. And hopefully putting it into some companies that, like I said before, are going to continue to grow with the market. Maybe some of them are like kind technologies, but maybe you're moving in a different direction from sector. You know what I mean? Sector perspectives. You want to go with more safer investments in utility companies and things along those that are just kind of steady earners. So.
Yeah. Eric, what are some of the best tips for younger clients to start building wealth today that you've seen?
Recurring savings plans. Make more money.
Wake up.
You haven't had another cup of coffee.
Yeah, I mean, for everybody, it starts with the 401k match. Contribute as much as you can to get that. A lot of companies, it's like 4%, right? And then if you can on top of that. But if you need more flexibility, you're younger, you're trying to get your first home, maybe you only want to do just enough to get that match. It's free money. Rest you're saving in a brokerage account or Roth account for your first time home. After that, just putting money away, letting compound interest work.
How much can someone put away in a Roth? That's dependent on their income, right?
Yeah, I gotta look at the income rule again.
The contribution limit, it changes every year.
7,000 for people under the age of 50, and then it's for people over the age of 50, it's 8,000.
Yeah.
Because they got a catch-up contribution, and then it's to do what's called a Roth conversion. Like, let's say, for example, if you don't have any other IRA money, but you're over the income limit for what for your ability to contribute to a Roth, you can put money into a traditional IRA. Okay, so it's post-tax because you make too much money and you participate in a retirement plan at work. So you lose your tax deduction for contributing to the IRA. So what happens is it's essentially post-tax money going in, and then you do what's called an immediate conversion to the Roth. And that's like, they call it a backdoor Roth, a backdoor Roth IRA conversion.
Yeah.
And that's a way to do it. You just have to be careful if you have any other IRA money that was all pre-tax, you're subject to the pro rata rules, and that can kind of blow that up a little bit, where a lot of it can become taxable.
Interesting.
So that's the thing, you know what I mean? People have to be aware of.
So you kind of want to strategically do that. Maybe in a year you didn't make a lot of money. Is that right?
No, it doesn't actually. It's not dependent on income.
Oh, it's not. No.
Because again,
Okay.
you're putting it in post tax, so you're not getting a tax deduction. You could make $5 million a year, right? Let's say but you don't have an IRA. Okay, it's all really comes into play whether you have an IRA or not.
Right.
Gotcha. I think I misunderstood. I got it. Makes sense. To me, I always look at this stuff and it's like, I wish I had saved way more, when I was younger. Can you save? Because that's like, I know. I'm just saying, like, I think that's a
but
huge
everybody
piece of it.
wishes that. Like, I don't. Lifestyle's important too.
Absolutely, and it's got to be a balance. But there's definitely a piece of it. I would imagine is like, can you save more than you're spending? And it's super basic. Sounds simple, but
Yeah, I think it all comes back to, you have to adjust your lifestyle, like, very early on. Those people who are able to do that and say, like, this isn't, that money that they're taking out, like, I'm going to do this much a month, and I'm not wavering. You know what I mean? Like, I'm just, I'll make exceptions.
yeah,
Your things that you want to do, you got to find a way to do, like, cheaper things, right? You know what I mean? Things like that. So, and I think
It's like
that.
you want to be the friend who has like no money in the wallet, and they're like, but they've got tons of money in their investment account. It's like, sorry.
Yeah, well, you know what? Then down the line, you can pay for all the drinks. You know what I mean?
Exactly, right.
You'll have all the money. So, no, but that's the thing. I just think early on, you just have to make lifestyle choices to, I'm gonna save this much, right? No, you know what I mean? No matter what, that's the thing. You just have to put that on, make it attainable. You know what I mean? At a time, and live within that. And you're gonna have to sacrifice. But I think it's safe to say, like, nothing is built without sacrifice, right? You know what I mean? There's even, like, right, people look at a lot of these billionaire, owners and stuff like that, and what was life like in your 20s and stuff like that? Oh, I lived at the office for, you know what I mean, for 6 years while I was developing, you know what I mean, whatever. I didn't do anything, you know what I mean, stuff like that. They make it seem like it's some glamorous ride up to the top. It's
Yep.
often not.
It's never
not the case, right? That no one ever sees the late nights, the catastrophes that go on, things like that. All they see is, oh, this person's worth $3 billion. Like, look at they got it made. They're so smart. They came up with this thing. They don't see that the people were kind of hanging on, you know what I mean, for dear life several times and things like that, thinking like, oh my God, I'm never going to get this company's never going to get off the ground. Like, you know what I mean? We're not, there's probably, God knows, thousands of ideas, right, that are great, but
I love
the right
that, yeah.
acting, didn't get the right marketing behind it, didn't get so the execution just wasn't there.
So true.
For some brilliant people, right? People who are, just so much smarter than, you know what I mean, than others, and it just didn't work out for them, right? So
Yep.
I think most people, if you take that perspective, they can take that, you know what I mean, couple $100 a month or whatever early on, right? You know what I mean, when you're maybe not making that much money, and be like, all right, this is gonna get put aside no matter what. This is a priority. If you do that early, you're gonna have that much more money when you're 30. You're gonna have that much more money, you know what I mean, when you're 38. Because you're gonna have that money is gonna be like a second job for you. You know what I mean? It's really gonna be working for you.
Yeah.
Yeah. The power of compound interest.
Absolutely. Yeah.
You're gonna hear that over and over again. It is an amazing thing, and the more time you got, one of the reasons why Warren Buffett is so wealthy, apart from the outsized returns that you know what I mean, that his company has provided, is the fact the guy's 90. You know what I mean? He's 93 years old. He's had all this time for his money to compound.
Compounding.
So it's like, it's insane.
Yep. I like the way you just said nothing is built without sacrifice. I think a lot of people, don't realize that. And this whole like grass is always greener. I just heard this quote from Alex Hormozy on his podcast, and I thought it was amazing. But it was like the grass is always greener on the other side, and that's true. But what you don't realize is that the other side's grass was fertilized with manure, right? So it's like everyone goes through shit. It's just like
Yeah.
like it's always hard. It's like pick your hard. I don't know. I think that was very, very good. That's going up
That
on
was
the
good.
wall. for
I'm
you to-
feeling inspired.
100%. Yeah, it's no, but it is. It's just the glamour. It's not there. It's you know what I mean. It's
Yeah.
a lot of times it's the struggle, right, that leads to the good stuff. So
character
yeah,
building.
you got to commit. You got to commit to it. You got to be disciplined.
Well, yeah. I mean, it's like choose your hard, right? Like, yeah, it's going to be hard to live under your within your means or below your means. It's also going to be hard to be poor in the future, right? It's going to be hard to work all long, nights and weekends building your dream business or whatever it is, like putting the hours if you're an entrepreneur in the office and rising to the corporate ladder. That's going to be hard too, but it's also going to be hard.
Yeah, but even if you don't want to, like, I'm not saying that everyone has to work. You know what I mean? A crazy amount. That's not for
Totally.
everyone.
Absolutely.
Right, but whatever you do, you do have to make sure that you're disciplined within your means.
Yeah.
You know what I mean? So that's the thing. So not everyone wants to constantly grow every year, and you know what I mean, and things along those lines. They could be have a job that they really like,
Yeah.
enjoy. But
Oh, absolutely.
They have to make sure that the savings is a priority, right? And
Yep.
because again, you don't want to work hard. Well, guess what? You need your money working for you then, because that's going to be working hard, and that's how you have to. You know what I mean? You have to treat it like you don't want to work hard. Let your money work hard, right? So you have to make sure that you're disciplined in your savings.
In your investment strategies, yeah. And I think the tax, like building your team, I think is key. So like who Eric, just to like wrap things up, and maybe Bill, you want to say some final thoughts, but who should be on the team? Like, as you consider, if you're younger, you're putting your team together, who needs to be on that team to help you ensure that you're going to be well off in the future?
Your advisor,
Your financial advisor.
your state attorney, yeah. Your in-laws, your wife, your husband. Yeah.
Why an accountant? Like you said, accountant.
I mean, we've just been listening to an accountant ramble for 30 minutes here. Bill, he's a genius. Well, but that's the exact. I mean, but that's the exact kind of person who can help you with the restricted stock units, like we were talking about, right?
Yeah, I think tax
do you want to
strategy.
sell them this year? What's your tax liability? All that stuff. He's going to find you the savings annually.
Yeah, it helps from making dumb decisions, right? You know what I mean? So
Well, I think it puts it all together. It's like the whole 360-degree everything all together.
yeah, and a lot of people too. I think especially going back, like we're talking about the markets, these whipsaw.
Yeah.
A lot of people are very impulsive, right? Especially with investing and things along those lines. And sometimes it's good to take something out of your hands, right? You know what I mean? Where you are so worried about something, if get it out of your hands, right? Get it out of your hands so that you have that layer there to kind of help make those better decisions, right? I think
Yeah.
what are Peter Lynch
Because we can remove emotion from it. That's the thing.
right? So, yeah, that's the thing. We take
As
that
best we
out
can.
of the
As best we
equation.
can.
Yeah, we try, you know what I mean. We try to. I would love to say that I don't do things to appease my clients, but there are times that I will settle. A lot of times I'll tell them, I say, I don't think this is the absolute best thing. You know what I mean? But I want you to sleep well at night too, right? So,
Sure.
so I will I will talk of my displeasure with certain decisions, but just having that extra layer that allows you to again talk through, take a step back, you know what I mean, and because that's a big difference, right? I mean, even if a lot of times people talk about the fees that advisors charge, right? Oh, it's detrimental to your overall return. Okay, well, what about if your asset allocation is off by just a hair? You know what I mean? And you're you're putting into a position that is actually a lot more detrimental than any
For sure.
fee that a planner charges, right?
Or if your tax is off and you're paying way more than you have to, I would imagine.
and you don't even realize it, right? Those things there could be wildly detrimental, and and it's tough, right? If you're a working professional, you don't have a lot of time to be delving into that stuff all the time.
Exactly. Yeah.
Right.
Well, any last words, Eric?
One thing to leave people with is just to remember that, it's been a tough kind of last week in the market, 2 weeks, whatever. But to just remember that the market's forward looking. So, it being down right now, they're pricing in economic decline. It's already priced in. The economy hasn't even declined yet. But oftentimes this is when the rich get richer. I'm not saying it's not going to go down a little bit further, but a lot of economic decline is already priced in. So it's time to average in, put more money in, or at least at the very minimum, stay put. Do not panic. That's all I will say.
Yeah. All right. We'll see you guys on the next show.
It was Peter Lynch who said, far more fortunes have been lost, right? You know what I mean? Due to bad decision making, in times of turmoil than any market downturn, right? So making bad decisions then, that's where a lot of the money is lost, not necessarily the downturn itself, because they've, up to this point, have all come back, right? So,
Right. Absolutely. No, it's a great reminder for everyone listening. So, great episode, guys. To everyone listening, make sure you share, like, follow. We are not running ads against this. We just grow because of you. So give us a share, give us a follow, and we'll see you guys next week.